Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Alconin, along with Brianna Valesky, and I have Angie Maguire on the line, Vice President of Grain for Citizens Elevator, better known as the goddess of grain out there in the Twinnersphere. Angie, how you doing this morning?
Oh, I'm doing great. How are you doing this morning?
Good. Well, busy day yesterday with all the crop reports out, and let's just get your first of all your general appraisal of them, and then we'll go into some of the individual issues.
Yeah, we can do that. Yesterday was a busy day because we get both the old crop, the stuff that's in the bin right now that we're trading currently, in the new crop outlook. It's the first official new crop outlook from the USDA. So we got to look at what the USDA is expecting as we move into next year. And basically, yesterday's numbers, there weren't too many surprises. In the past, the old adage is big crops get bigger, and that's what we're seeing a little bit. Is we know that we have a good amount of ending stocks left over for corn, soybeans, and wheat, both domestically and globally. And there is some anticipation that, from a domestic standpoint, we'll see some reductions in production going forward, but the surplus in stocks that we knew was there is basically giving us some padding for weather issues or anything like that. And we saw the USDA basically come in yesterday and solidify that idea that there's still going to be some stocks and some surplus, and it's going to take some sort of weather issue to really tighten things up as we move ahead at this point.
Okay, moving on to the corn market here. You had that nice run of October through the end of the year, and just kind of a lazy pullback here. And are we putting in another little bottom here? It kind of looks like we're trying to find support over the last couple of weeks. Doesn't look like you can take it much lower. Not quite a 50% retracement here, but could you be putting in a little bit of a bottom here in the corn market?
We're hoping so, especially as we work into the really volatile production season that we're getting into. We've had decent planting progress. The weather's been good for the bulk of the corn production areas that we've got. Decent rain, warm temperatures. It's been one of the best starts to planting we've seen since 2012, which most people in agriculture will tell you that 2012 is not really a year you want to talk about because that was our drought year. But we've seen things go real well here. We've had some instances with the bird flu or some, just some real strong pushes in the downward direction here recently, just with bird flu and a lack of risk premium in place due to the quick planting. So we're hoping that we're carving out a bottom here. The spec short position, the fund short position that we've got going on makes it difficult to see any true additional selling, we would think, as we move forward, ahead of the pollination period, because July is where about 90% of the yield variability, or as the USDA says, or where the yield comes from, is in July. So we're still 8 weeks away from really knowing what we've got for a crop, but the idea right now is, as we move ahead, perhaps we'll see some risk premium put in place, just with the fact that we lose four bushel to the acre nationwide, and the entire supply and demand outlook for the new crop year is changed. So it's not quite a guarantee yet that we're going to have these burdensome stocks that everyone's talking about, but right now trade's not really interested in coming in to buy just because they can't guarantee that they'll get anything out of it at this point, I'd say.
You mentioned the commercials there. Do you, and the commercials are, large speculators in the commodity markets. Do you use them as kind of a contrarian indicator or pretty much go with them?
You try to go with them. If you start to see them sell pretty actively, you know that trend's probably, you're probably not going to do well to stand in front of that train, especially if the fundamentals indicate. And that's typically they're a 1,000-foot fundamental view. They're not necessarily down on the ground seeing what's going on. They function a lot on headlines and just a general feel of the market. So they tend to follow the trend. But once you see them get to the level of short that we're seeing right now, which is close to that record level, it's going to take something to really kind of, like I said, pile on. So at this point in time, you tend to try to want to take the contrarian view, because it's just like anything else. You do not want to be the last guy out if something turns and that position goes against them. If we see a weather issue develop, the one thing that is, commonly discussed right now is if you see a weather issue develop, this thing's going to be like, when you're playing pinball and you pull back to let it launch. I mean, you're basically looking at that sort of market reaction or the potential for that, just because no one's going to want to be the last guy out the door. And so that's the one thing that people are watching and waiting for is there could be something that could happen, from a weather forecast perspective. And really right now it's purely weather just because we have such adequate supplies. But we could come in on a Tuesday and that short game could not work for them, or they could decide, with the dollar falling off and an increase in certain areas of demand, they could decide they don't want to be short anymore. And at that point in time, it's uncomfortable for anyone who is, and things could change quickly. So that's why we watch it, is just to kind of get a feel or to know what your risk is when it comes to them actively changing their position, or continuing to build on a position, as we've been seeing here over these last 6 months.
What about these beans? Holy Toledo, look at the consolidation in those bean farmers must just be pulling their hair out here. I mean, this thing is just not moving. Have you seen a period of consolidation like this in the soybeans, and how and when will it be resolved?
Yeah, I mean, we've seen it quite actively in the past. I think more so we've seen it before. It's just the same story, different chapter. We saw a lot of it with corn last year, and you tend to see it a lot in commodities where you discover or you're trying to find a quote-unquote fair market value. And the hard part with beans right now, and the hard part with any commodity, lesser so corn, just because the demand is a little bit more known in some sectors. But the hard part with beans right now is we've seen the spreads invert. And the spreads between commodities, of course, indicate when you have a significant amount of carry, tends to be more of a bearish signal, i.e. the market's trying to persuade you to hold those stocks off and out of the pipeline. Well, when you tend to have a large amount of stocks on hand, you will see that carry develop. The bean market has transitioned more into an inverted market structure, which is more indicative of a bullish cash trend. So there's a little bit of uncertainty with beans, i.e. the USDA is telling us we have 3 times the amount of stocks left over, or we will, at the end of this year than we did at the end of last year, and are looking at the potential for an additional 40% increase in ending stocks again next year. But the cash market, the strengthened basis, and the lack of carry in the spreads is telling a little bit different story. So a lot of folks are saying beans need to go lower. We really don't want to encourage an increase in production, in the U.S. this coming year and in South America next fall. But at the same time, people are saying, based on what we're seeing from a cash perspective, they need to stay high in order to encourage or continually replenish the cash pipeline, which has been surprisingly thin with the amount of crop that we have. So on the bean side of things, and especially with beans, you get a dry stretch in August, and we go from a 500 million bushel carry out, to a 250 perhaps if we lose, 2 or 3, 4 bushel a acre, whatever it may be. So there is some real risk in that just because the Chinese demand's been so great. And there are some questions as we move ahead as to whether or not the USDA is underestimating potential Chinese demand as we go ahead. I mean, I mentioned it on Twitter yesterday. The one thing I find interesting is China has really been focusing on building their grains, their wheat, their corn, et cetera. So they've been putting a lot of subsidies and things in place to help encourage their growers to increase acres there. They have been trying to discourage growers really from growing soybeans because they can import them. The USDA yesterday showed a drastic increase in corn and wheat production as we move ahead, but a not so drastic increase in soybean production. So Chinese demand has the potential to really swing ending stocks as we go forward. So I think there's some support under beans, but yesterday was basically wow, we know that things are bearish, but the USDA really gave us a bearish number, and that's what we had to trade in yesterday's. I mean, down 15 cents in one day is never pretty.
Okay, and also, I don't have a wheat chart up here, but we've talked about all the other grains. Just to give us a wrap on wheat.
Wheat, everyone grows wheat. So that's the beauty part about wheat is if you have a production issue or something of that nature, a lot of times another country is going to make up for it. Well, the one thing that we've seen, over the last 3 to 4 years is high prices, in the 2010, 11, 12, and beyond. I mean, prices encouraged production globally. And last year we had an epic crop come out of the European Union. I mean, it was just a very large crop that came out of there. And then again, Russia and other areas in the Black Sea were big. So we've seen wheat carry out in the U.S. Shrink up a little bit because we've had some production issues, but we've seen from a global perspective, carry out has grown significantly, and it's anticipated to continue to grow. So wheat for us has really been a struggle. Our exports have been down. Soft red wheat really had a hard time last year with disease issues, vomitoxin. It's you basically can't deliver into the pipeline with something like that. It has to be set aside. It's blendable. It's not something that causes a huge issue, but it's an issue. So we did see that, and with the strength in the dollar, we saw a downturn in exports. So we've had a really rough time. There are some questions with what the USDA said today based on yield projections, if we'll actually see it. Wheat's like soybeans. It's very difficult to tell what the actual yield's going to be until you run the combine through it. So there are a lot of questions. There's still a lot of questions on quality out of the hard red wheat crop with all of the rain that we've seen recently. Rain makes grain until it creates disease problems, basically, is the thing with wheat. But for right now, we're basically looking to see, as we look ahead, there's talk that we have a really interesting El Nino weather pattern setting up. That tends to cause weather issues in Eastern Asia, Australia, and some other areas. So the question will be, of course, what we see for long-term production. There's some interesting conversation coming out of Russia and Ukraine on whether or not their production estimates are accurate as we move ahead. And so there's a few unknowns, but when it comes to wheat right now, it's the same as anything else. And actually, it was the leader of this surplus crop move. And so that's where we're at. We're just kind of stuck. We have a great supply of wheat globally. Domestically, we're using quite a bit of it, but from an overall standpoint, it goes right back to everything else. China's going to be the pivot point, and that's where we're seeing a lot of stocks building up is in the Chinese wheat crop realm.
Are you familiar with and I'm trying to find the symbol for it here. There's an ETF that tracks farmland. Are you familiar with
Okay.
it? Are you familiar with it at all?
I've heard it discussed. I haven't seen it myself, but I have heard it discussed, yeah.
Yeah. I'm looking for it. Brianna's helping me here, and I'm trying to find it. I mean, maybe let me try farm here real quick and see if that's it. But while I'm digging it up here, nope, that's not it. Oh boy, I wish I could find it. Maybe it's land, LAND. But anyways, while I try and find the chart here, what's global land, Gladstone land? No, what would be your take on the ETF like that? I mean, they're certainly not making more land, right, for
No.
farmers. What would you be? I'll find a chart on it, but you give me your take.
Oh, my take is exactly what you said. They're not making more land, and land is a precious commodity, similar to, I mean, it's very difficult. It's a unique situation. But the one thing that we have seen recently is the high commodity prices have encouraged high land prices, of course, because your revenue per acre has been so great. Now we're seeing some real significant issues with the high land prices and the ability to pay for them with the value of the commodities falling like they have. I've got a lot of guys that are looking at corn values right now, and even with the cheaper land values that we see here in Michigan, they're struggling to pencil out a break even at this point with prices today. So the question, of course, is going to be, where do we see or the expectation that if buyers diminish, of course, the value will soften a little bit because the pool of buyers is going to shrink up a little bit. People are going to start to reevaluate the kind of expenses that they're making. But at the same time, we have a lot of land management companies that are using retirement investments and things of that nature to come in and buy farmland because, as you said, we're not making any more of it. So there's this kind of a real divergence right now between the intrinsic value that land has and what the actual value will be. I mean, a bank can sit down and say, okay, your land's worth $7,000 an acre, but until you can have a seller come in and pay that much, it's not worth anything, really. I mean, unless you have a buyer come in and pay that much, I mean, unless you have a buyer at a quoted value, it doesn't mean much to anything. So the question as we go forward, of course, will be who is going to be the buyer. Of course, your investment firms and things of that nature have much deeper pockets. That's one thing that a lot of folks don't want to see happen is U.S. farmland go way of commercial investors and then farmers, farming for them on a lease standpoint. But it is happening. It's been pretty common, and I think that in and of itself will keep support under values. The big question will be for landlords, those who own the land and are offering it up to the farmers from a rent standpoint. I think they're going to start to, I think they're already seeing it, but they'll be the next ones in line to have to tighten their belt because there comes a point in time where a farmer needs to make a decision that farming the land, yes, is great, producing a crop, etc., but prices do not cover the cost that they're spending.
Okay.
So that's the one thing that we're looking at on that, I think.
Okay, I found it. It's Farmland Partners, and the ticker is FPI. And yeah, it's moved up since October here. It's had a little bit of a rally, nice little pullback here. But if you want to participate in farmland and exploit, investing in it one way besides doing it in the commodities. We've been on with the goddess of grain on the Twitter. That's Angie Maguire. She's vice president for Grain for Citizens Elevator. Wrapping up the USDA reports from yesterday. Thanks a lot, Angie. Great outlook. We hope to talk to you again soon.
Thanks for having me. We'll talk to you soon.